I'll combine both.
Okay.
Firstly, it's an opportunity to rebalance and see in your portfolio whether you have actually have exposure to the wrong stuff.
Okay, what is the wrong stuff?
Yeah, the wrong stuff is basically stuff that's actually exposed to the wrong sectors at this point in time.
Oil.
Yeah, exactly. Well, oil is basically trading at a very at a multi-decade low right now, so it might not be too bad to actually start picking up some of the U.S. oil energy companies. But even within the oil sector, you can actually do a little bit of rebalancing, right? Okay. If you're exposed to the shale gas, shale oil industry, then obviously that's an area that you don't really want to have significant exposure to. Right. But I think where the U.S. energy majors are concerned, there is space for them, because after this round of consolidation and mergers and acquisitions, there will always be a few big names left. And you want to be exposed to those big names. So that's what we're saying. Have exposure to some of these guys, because that's going to be very positive for your portfolio. And they've been beaten down really sharply, right? Okay. So they're actually undervalued. Okay. But the undervaluation is not just restricted to the sector. For example, if you look at the Singapore stock market as well, the market has been completely beaten off. On a valuations basis, it's actually well below evaluations. The banks are trading at about 0.85 to 0.9 times book. 10-year average is about 1.4 times. During SARS, 9/11, they were trading at about 1.1 times book. So it's actually well below valuation. So, things like that you got to pick up.
You're telling me that Singapore banks, and these are some of the bluest chip banks here in this part of the world, are trading not just below 1 to book, they're trading below Asian financial crisis levels?
Yeah, absolutely.
Wow.
During the global financial crisis, the banks traded down to about 0.6 times book, but that was just for a period of about 3 months. Okay. And then after that, they actually rebounded back. Right. But even if you price in the fact that there's a significant amount of its exposure to the commodities or to the oil and gas sector is actually going to go bad, they shouldn't be trading at valuations below book. I mean, it shouldn't be such a huge disparity